When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events, also tax-smart investing strategies for those nearing retirement. Then we'll answer listener questions, and then finally, liquidity triggers. My name's Jeff Shea. As always, I am just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. It is Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
Doing great. Always fun to be with you on the weekends and the listeners. So let's have a fun show.
Glad to hear that, Jeff. Hope our listeners are having a great weekend. As always, we really appreciate you joining us here for Premier Retirement on KNST. Well, Jeff, the S&P 500, the NASDAQ just hit some fresh records. It's, I think, fueled by excitement around AI and expectations of Fed rate cuts. Gold's also at record highs. Jeff, what's behind this rally, and should retirees be excited, or do you think they should be cautious?
Well, I think a little bit of both. I mean, it's exciting to see gold go up if you have gold, or if you've been able to ride the wave and buy some ETFs that are gold related, or if you even have gold in your safe and you want to just know it's worth more money, even though you're probably not planning on spending it, except in dire straits and when the world melts down. If you want to play the gold price increases, there's plenty of ways to do that through, mutual funds, ETFs, and stocks, gold producing stocks and things like that. I think the main driver of the gold prices rising, I believe, is China and a lot of the world central banks that are trying to acquire gold as kind of their hedge against what they see, and what I think everybody who's really even a little bit economically savvy knows that the world can't keep printing money. Everybody's doing it. And they've kind of built this fake economy, fake gross domestic product growth. The GDP is growing at a very slow rate, but it's fake. It's a lot of stock buybacks. It's a lot of earning projections and not real earnings, things that don't really strengthen the economy. We look at jobs going down and things like that. And there is some worry. And so gold has typically been a hedge for those troubling times. And there's other countries that have already been in troubling times. China's been in recession for quite a while. Japan's trying to keep their head above water. Most of Europe is finally recovering, but it's not the robust economies we knew of a decade or two ago. There's probably a little bit of worry out there. So central banks are starting to buy up gold. They're hoarding it. The other thing is gold and silver and other things like lithium and antimony and other precious metals and rare earth metals are getting very popular just because of the application they have in the high-tech industry with chips and alloys and things like that. So there is probably a reason to try to get on that bandwagon and hoard the actual gold. And I guess from the standpoint of just controlling a lot of the wealth and a lot of the growth, especially in the tech sector, it's kind of weird how that relates, but it does. The other thing is it's really just kind of a supply and demand thing. The miners can only produce so much so fast. And if people are buying gold ingots and sticking them in their safe, that's less for the industry to be using for actual ores and metals and industrial materials. And so that creates a little shortage there. So the prices go up again. So there's some demand issues. I think, we haven't really seen the end of it, to be honest. In my opinion, we haven't seen the end of it. I think there's some decent place. Now, having said that, I think just like the stock market, a lot of the gold stocks and a lot of gold-related investments are probably overvalued because of the frenzy, the feeding frenzy. And I think so from that standpoint, we probably ought to be a little bit cautious. The other thing is if China, who I don't know if their central bank owns more than we do or the big banks in the U.S. own, or where the holders of the gold are. I could probably look that up. I probably should just for giggles. But bottom line is any of these big, huge countries could dump gold and cause it to go way down. I think they did that last year. There was a little sell-off in gold where it went back down, retracted a few $100s per ounce, and people got a little bit scared and said, gold, is it over? And hit 2,500 and we're not going to go up anymore. What's going on? It did resume its uptrend. But buying and selling is really what controls, and the demand controls the price of anything. And I think that's what's driving gold and silver. Silver's catching up, though. Silver's catching up with a vengeance. I mean, over $40 an ounce now. I haven't seen that in, I think, 14 or 15 years. We've got gold at all-time highs. For some people, they say it's just a start of what's to come. 5,000 gold, $10,000 gold in a year or two. I think that might be a little bit aggressive to believe that, but it does filter back to a lot of the producers and miners in the ore business, in those precious metals businesses. So there are some opportunities to invest if you think the AI business and the AI stocks and the chip stocks are a little overvalued, like I do. And even though we're still making money on them, you have to be careful because you have some stocks that'll double or triple in a year or less, and then all of a sudden they sell off 30 or 40%. And you really just don't know when to take those profits off the table, especially when they get so overvalued. So you have to be a pretty nimble trader, pay attention if you're going to make money in that. But I think from the standpoint of more of a buy and hold prospect, I think gold probably has a better chance of that than some of these AI stocks, which may be few and far between from the standpoint of who survives and who doesn't, just like the dot-com era. So many dot-com stocks that were, all you had to have was dot-com in the name and it would go to the moon. There was dot-com stocks that didn't even have a phone number or an address. It just had a dot-com and a filing in the Securities and Exchange Commission and somehow had an IPO. People bought it and people got rich, left with the money, and a bunch of people got poor after that. So, the AI business is probably going to be the same. You're going to have to be pretty picky as far as those stocks that emerge the winners. Of course, some of the big blue chips will probably do that, but they're the ones that are somewhat overvalued. You might get some opportunities in the smaller cap stocks, but we'll see. But again, back to your gold and silver thing, is it worrisome? Yeah, anything that goes on a feeding frenzy like we've seen is a little bit worrisome, especially when our market and markets in general anymore are not really in control. In other words, it comes down to a supply and demand issue. It doesn't come down to a fundamentals issue. It doesn't come down to much of anything other than if somebody wants to pay more for it than somebody else and drive the price up, or if somebody wants to sell it, forcing you to take a lower price in order to unload it. You have to follow the money, and it's an exciting, exhilarating game if you want to be in it. I do it for a living, and it is a little bit exciting and exhilarating, but we do that with caution. And we also make sure that people who are in the market, regardless, even in the gold and silver side of the market, that just because there's a commercial on TV and some movie star says he's buying gold from some company and gold has never been worth zero. Well, yeah, so, but it's been worth 80% lower than it is right now in the not too distant past. So you have to approach everything with caution. Don't risk money in anything that has upside and downside potential that you can't afford to lose. That's really been our mantra from the time I started this business over 30 years ago, is like, I want to help people not lose their money. And where there's opportunities to grow, great. Let's put risk on those assets that are not being used for current income or near-term income or near-term emergency cash. So be careful as far as how much you want to allocate in those type of things. I still think there's some upside in the gold and silver market. I don't like making predictions and having people hold me to them, but I mean, that's my opinion. Yeah, we'll see what really happens. My opinion was that the market was due for a crash, and it still is my opinion. Doesn't mean it can't go up for another few months or a few years. I mean, I don't know. It just, the market does what the market does. Play carefully and don't risk what you can't afford to lose when you do it.
Talk with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson, also with an office up in Mesa. Again, we're talking about current events. I want to remind you, our phone lines are open right now. 520-780-9059 is our number. If you'd like to come and sit down and talk with Jeff about your journey towards a confident retirement or building wealth, certainly we would be happy to help you at no cost, no obligation whatsoever. It's just a friendly conversation, an opportunity for you to get some questions answered at no cost. 520-780-9059. You can make that call right now. Leave your name, telephone number. Shelley will call you back and set up that appointment. Again, no cost and no obligation. You can also find out more about us online at primret.com. Jeff, let's continue our conversation here. The markets now expect the Fed to cut rates later in October this month and also maybe again in December. How could that play out, do you think, for stocks, bonds, and income-oriented retirees?
Well, we saw a rate cut just recently. There's still a bunch of selling in bonds. The bond prices go down and long-term interest rates go up. Mortgages get affected, car loans, everything you borrow money on is actually getting harder and harder to borrow, not cheaper. Only the short-term overnight bank rate is all that they were able to really lower, unless they start printing money and buying up all the bonds that are out there. But you've got countries, again, I'll call China out. They own so much of our debt, trillions of dollars of debt, and China owns so much of it. All they have to do is start selling our bonds, drive the price down, and it makes our interest rates go up. So if they want to retaliate against us for the Trump tariffs and all these things that they feel are wrong acts against them, they have a lot of leverage against us, unfortunately, and they can keep the interest rates high. So I don't think anything that Chairman Powell does is going to matter. I do think that while interest rates are up and it makes things hard to buy for younger people, the new generation, our kids, our grandkids, buying cars and houses and even student loans and everything that is being offered at a much higher interest rate than it used to be makes it less affordable for those people. Now, as far as a retiree that wants safe money and can put money in a CD or a bond that pays 4 or 5% or better, that's keeping ahead of inflation based on the high twos that we seem to be in. And it's been a long time since we've been able to find fixed interest at anywhere close to inflation rates, right? So from that standpoint, a retiree has some opportunities that makes things look a little bit better, especially if they don't want to put all their money at risk in the stock market, which is so overvalued, it's scary, and they know that they could lose a lot of the nest egg that they've worked a lifetime to acquire. So things that are interest rate based, especially annuities that guarantee income, even the LERPs that guarantee lifetime tax-free income and death benefits and things like that are based on a higher interest rate today than they were 5 or 10 years ago. And so the opportunities to get products and services that are offered in the financial world that produce better income, more security, and more peace of mind and confidence during your retirement, you're going to find that the products today at a higher interest rate are much more conducive to providing that without you taking as much risk. So there's gives and take for the standpoint of, can you make enough extra money on your investments or enough peace of mind where you can maybe help your kids out to buy that house because they can't afford it? I don't know if that's the give and take that people are going to have to do, but I see that happening more and more often, that some people who still love their kids and want to help them out end up finding themselves in a much better financial situation because of high interest rates, obviously, than the people in the other situation. However, if interest rates go down, what happens generally? If interest rates go down, usually prices go up because the wealthy people that have assets can still afford to buy them. So will lower interest rates actually help people buy houses? Well, if the house prices don't go up, and right now, housing has been falling. Phoenix and Tucson down about 20% from a year ago. That's pretty significant. And keeping in mind that we're giving back a lot of the gains that we made over the last 5 years or so since COVID, when the housing prices have just gone crazy and people have been moving to Arizona. I guess they love the climate, love all that it has to offer here. And I don't blame them. I raised my family here. I love being here. I love the community that we formed in Premier Retirement Planning and Wealth Management. We got a great community of people I would never want to leave. I like the culture, the climate, everything about it. So I understand why people want to move here and drive prices up, but interest rates going down, I'm not sure if that's going to help. I think it might just make the cost of houses and things go up a little bit to still be kind of in line with whatever people's used to paying in payments, which doesn't really bode well for people's savings. I just read a stat that almost 50%, I think it's 48% of adults don't have anything, aren't able to save a dime, that aren't saving anything for anything, not even emergencies, let alone for a down payment on a house or things that they may need. So the housing market, the interest rates and things like that are pricing a lot of our society out of the American dream and out of a lot of the American dreams to be self-sufficient. And I just mentioned last radio show, maybe it was a time before, but there's more part-time jobs now than full-time jobs. And I think that's a lot of second jobs, or it's because employers can't afford to pay benefits and do things that they're required to do for full-time employees. So people are underemployed and have to get second jobs, or their full-time job has now been reduced, so they're going to have a harder time making it. I don't know how anybody can say that we're not heading into a recession or don't have symptoms of recession already. We have for a while, and they're getting worse. The economic indicators are all getting worse. Prices are getting worse. Interest rates really aren't coming down as much as the lip service of Jerome Powell says they are. They're not. And so to answer your question, if they have another rate cut in October and December, it may not make a difference at all in the way anything happens, other than it'll probably give the market a reason to rally and for more wealthy people to throw more money at the market than they already do. And right now, the amount of money that's in the market that isn't even real money is astounding. Some of the prices increases on these stocks are based on margin buying, meaning that a company, for example, I have an account, and they tell me all I need is 30% of actual stock. In other words, if I have $500,000, I can actually borrow basically 3 times that if I want to trade stock. So I can basically have somewhere between $1.5 and $2 million in stock if I feel like it. Wow. So what if the market goes down 20%? I lose all my money, not just part of my money, not just 20% of my money, because all that's borrowed. So people understand just how devastating playing margin can be. And unfortunately, it's the people that are playing margin are the people that don't understand it and don't understand that they're going to get whacked double or triple the losses when the market goes the other way. Some people have been getting rich using it, but that's a double-edged sword and people have to be careful. I know I got a little off track here, but from the standpoint of interest rate decreases, I think all it'll do is probably make the market have a reason to go on a feeding frenzy again. But then again, if the economic statistics keep showing up as, a negative trend, that job growth and earnings keep going down, producer prices and consumer prices keep going up, more and more people are unemployed, it may not matter that interest rates are going down. The writing will be on the wall. And if smart money starts selling off, which they already are, but if they start selling off to a much higher degree and people get scared of buying on margin and start selling their positions, they're going to drive the market down and probably start to sell off that's been long overdue. So be careful. It's not a game. It's your life. And so financial planning is more about planning how not to lose your money than, hey, how can we throw money at the market? And we hope interest rates go down so the market will rally and we can jump on the train again and hope it doesn't crash before we get off.
You're listening to Premier Retirement with Jeff Logan, and we've been talking about current events here. Jeff, before we continue, I want to remind our listeners that if you're looking to preserve your wealth so that you can have a better retirement, you want to create an income stream that you can count on, you want to reduce taxes, you need the Premier Retirement Roadmap. And to get yours, no cost, no obligation, certainly. You begin that conversation by calling 520-780-9059. It's 520-780-9059. Leave your name, telephone number. Shelley will call you back during the week and set up that appointment for you. Again, no cost, no obligation, certainly no judgment whatsoever. Take advantage of the opportunity right now by calling 520-780-9059. We're also online at premret.com, PREMRET.com. Jeff, let's switch gears here a little bit. If you're nearing retirement, you've probably worked hard to save and invest, but the truth is what really matters is not what you make, it's what you keep after taxes. So let's talk a little bit about tax-smart investing strategies that can make your retirement savings last longer. Jeff, why is it so important to think about taxes when planning for investments in retirement?
Well, like you just said, it's what you keep that matters. If you pay a third of everything you earn in taxes, then you have to make at least a third more. And if you think about that, let's just say you make $100, but a third of it is in taxes and you end up only keeping 70. Well, what if you could earn 80 and not pay taxes? Well, you're better off, right? So you could have 20% less risk and still end up in a tax favored type of account, maybe be ahead of the game. So in other words, if a third of your money goes to taxes, you can make a third less. In other words, 50% less if you look at the amount. So if you want 100 to live on, you're going to have to make 150 if it's taxable. If you want 100 to live on, you only have to make 100 if it's tax-free or tax benefited. That could be through Roth IRAs. We like LIRPs, life insurance retirement plans, because you get money out tax-free. The crazy thing is the Wall Street model basically uses a 4% rule. It says if you have stocks and bonds, you should only take 4% a year out, even though over history, bonds have averaged more than 4% and stocks have averaged around 10. Why is that? Well, it seems to me you should be able to take 6 or 7% out. Well, you could if there was no down years. And the fact is, because there's volatility in the market, they've reduced that payout rate or the income rate to about 4%. But think of that, if it's 4% and you have to pay taxes on the income or the gains every year because you're either having professionally managed trades being made, or because even if you sell some stocks, even long-term holdings could be a 15 or 20% taxes. So you have to pull out more than you need to live on because you have to take the taxes off the top. So how about paying taxes now on your account balance where it is right now, and maybe pay taxes at today's rate, which in my opinion and most people's opinion is probably lower than rates will be in the future. I don't understand how they're going to keep on spending money and running into these huge deficits and wasting money and just throwing it away on stupid programs, in my opinion, too many of them, that just waste money without raising taxes in the future because they don't know, politicians don't know how to balance budgets. They're very rarely accountants. Some of them are businessmen, but apparently they don't bring a lot of that business acumen or savvy to the committees, or if they do, there's not enough people that agree with them. They just think that our money as taxpayers is their money. They can just take it from us and spend it how they want. They're Robin Hood, so they're making the world a better place by using our money to do it. And my opinion is you keep your money in your own pocket, keep it in your family, keep it in your community, and the world will be a better place, because when you send it to Washington, it's like throwing money down a black hole. You'll never see it again. You'll never see the benefit of it again. Nobody knows where it goes. All we know is the politicians continue to be worth more and more every year, millions and millions of net worth growth on a yearly basis. How do they do that? I don't know, but I'm cynical enough to believe that somehow it has something to do with it. So my job as a financial advisor and somebody that does actually do tax planning, we definitely give tax planning advice from the standpoint of how you invest your assets, what the sequence of withdrawals are to minimize those taxes. We can put it on a spreadsheet and enter the tax code and the tax brackets and see where your taxes are going to be. It's not rocket science, and it's nothing, in my opinion, that somebody who calls themselves a fiduciary and sells financial products that have tax implications should be exempt from giving or providing, yet everybody disclaims it. Oh, we don't give tax or legal advice. Go find somebody else. Well, so now you have to have like 6 different advisors. None of them meet with each other. They don't talk about stuff. And then the accountant thinks you're stupid because you did a Roth conversion, have to pay $50,000 in taxes. But when you show them that's going to save you $200,000 or $300,000 in taxes over the lifetime of your retirement plan, they don't see it because they're looking backwards typically. And so then you got a fight between your advisor and your accountant. And then you got some legal dude saying this trust will work for this and this doesn't do that. It's just, nobody wants to talk to you about how your finances work in regards to estate planning, taxes, and so many things, which they're really meant to solve those problems. So why in the world does your advisor disclaim that? I don't know. That's what blew my mind early in my career. And that's why I started my own business and said, you know what? I'm not going to do your taxes. I'm not going to give you legal advice from the standpoint of telling you how to dance around the tax code. We're going to use the tax code. We're going to use the laws that are in place, and we're going to plan with how those products work and how those tax strategies work in real life. We can share that with you. Shoot, everybody else is using them. We can see what they're doing. We can verify it. We have 2 CPAs on staff, one that does taxes and one that helps do planning. So it's not like we don't have access to good tax help by people that are credentialed and qualified. And honestly, it's kind of funny because I don't have a CPA designation, but I can dance tax planning around both of them. So if you're into that and willing to do that and can help people keep more money in their pocket, maybe your effective tax bracket, shoot, we delivered a plan just this last week that they got millions of dollars, but their effective tax rate is going to be under 6% if they structure it correctly. But guess what? They're going to be in the 24 to 30% bracket for about 5 years. After that, and for the next 20 years, they're going to be just way down low on that totem pole when it comes to tax rates. So how would you like to do that? Is to live on basically after-tax money by getting rid of that tax problem early on in your retirement career instead of later. Nobody likes taxes. Sometimes people hate paying taxes so bad that they'd rather just kick that can down the road. Thing is there's a time that's going to come when you can't kick that can down the road any longer, and you're going to be forced to pay big taxes, and you'll look back and wish you'd had a plan that took care of it early on when it was cheaper and, I guess, less painful.
Jeff, if someone is listening and they're nearing retirement, what's the first step that they should take towards tax-smart investing?
Well, I think you just need to do an assessment of all your assets, find out how much are in deferred accounts that you're going to have to be forced to take tax on later. You've got those RMD years, required minimum distribution years, coming up. In the next few years, it's going to be age 73. If you're born after 1960, then it's going to be at age 75 where you get to be forced to take IRA money out. And if you continue to defer it, let it grow and grow and grow tax deferred and enjoy some nice little tax breaks between now and then, you might find yourself in a much higher tax bracket on more money than you've ever had because those accounts grow, and you'll be in a higher tax bracket for the rest of your life. So you have to, first of all, take an assessment of what's going to be taxed. Where am I right now? How much do I need to live on? How can I maximize the lowest tax bracket possible for the longest time possible? We have a spreadsheet program that we've designed over the last 30 years and kind of it's morphed into our retirement roadmap. We also kind of call it our retirement tax map. And it's going to show you everything. It's going to show you the income that you should take, going to show you when to make those Roth conversions, when to pay taxes on your money at the lowest tax bracket possible, and get it all done so that you can live either tax-free or close to that tax-free lifestyle as you get older and as your estate grows in value. Because that's the last time, you don't want to pay taxes on more money. You want to pay taxes on less money and pay them at a lower rate if you can. Now, if you're in a really high tax bracket, it might not be feasible right now to pay taxes on all your money at a high tax bracket if you're going to be in a low tax bracket in a year or two when you retire. And at that point, maybe it makes more sense to do some Roth conversions or spend down your IRAs to live while you let your pensions and Social Security amounts grow to a higher level if you would defer those to a higher amount later. It's all about what you want, where you're at, what your lifestyle is, how much you want to spend, how much you need to spend, and tweaking the tax code to your favor, or tweaking your plan to apply the tax code in your favor. The tax code is a code. We know what it is. We know what the brackets are. So let's plan around them. I mean, we have all the information we need. We just have to take action and do it. And the best thing I can say is once you get a plan, stick with the plan. People that change the plan and bail out of the plan really hate it when it doesn't work. I hate them thinking it was me who did it. It's really when they don't, the plan would have worked if they just carried on and did the plan. The plans are pretty intact and we can tweak them as we go, but don't just bail on the plan the first few years. If you got a good tax plan, hang with it and you'll see how the pain up front will pay off in the end and for the long term.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management right here in Tucson, also with an office up in Mesa. If you're looking to preserve your wealth, maybe you want to create an income stream or reduce taxes, we certainly can help you with that. You've been listening to the program, you've been listening to Jeff, you know that he can do all of those things. We're a little bit different type of a radio program and a little bit different type of a firm. If you need something different, if you're not having these sort of conversations with your current financial advisor, we invite you to give us a call here at Premier Retirement at 520-780-9059, 520-780-9059. Schedule your complimentary, no cost, no obligation casual conversation with Jeff. It's not going to cost you a dime. You can also find out more about us online at primret.com. Hey, Jeff, time for a break. When we come back, we've got listener questions and more when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
We so much appreciate you listening to us on 790 KNST. This, of course, is Premier Retirement with Jeff Hogan. My name's Jeff Shade. We're here for you each and every week for your fiscal fitness, your financial education. We're on Saturdays at 7 a.m., 9 a.m., and 1 p.m. You can also hear us on Sundays at 11 a.m. We're also a podcast. You can join us anytime you want, 365, 24 hours a day, wherever you get your podcasts. You can also go to Google and simply search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows, so you can stay on top of your journey towards confident retirement. Again, phone lines are open, 520-780-9059. Call, leave your name and number. Shelley will call you back during the week and set up a conversation between you and Jeff at no cost and no obligation. Okay, Jeff, time for listener questions. We'll kick it off this week with Lisa, and Lisa is listening to us right here in Tucson. Lisa says, when my mother passed away, I inherited a significant number of Apple shares through an inherited IRA. My overall investments are about $600,000. And Apple now makes up about 50% of my portfolio. I've been taking my RMDs in stock rather than cashing in, so I'll still hold all of the Apple shares. I worried that a downturn in the tech sector or something Apple-specific could wipe out half my portfolio. There's also an emotional factor. My mother worked very hard and modest jobs most of her life. She bought Apple around $8 a share. The decision to buy this stock gave my mom financial security, and it feels almost disloyal to sell even a portion of it. I'd like your advice on how to approach this long term. Should I begin trimming my position and reallocating, or is it reasonable to keep building given my 10-year horizon?
Well, you do have a 10-year horizon, and you could either reinvest. I mean, are you going to take a little bit of it out as you go to live on, to supplement just the tax plan, or to build a tax plan? I mean, you might find that, I don't know your whole story or how old you are and good of health you are, but you could move that money and even pay taxes on it in the next 5 or 6 years and be done with it and put it in something that your mom could still leave to you, but you could put it in more of a tax deferred or a tax-free type of account that would generate some retirement income and do some things that would work for you, maybe create some peace of mind, and still leave some of those assets in those accounts for sentimental value. I don't like the idea of having that much money. Now, Apple's a great stock. It's been a great stock for a long time, but there are competitors to Apple who are already finding out the iPhone, the 17, is not really selling at great record pace like it used to. Tim Cook's a different guy than Steve Jobs. Steve Jobs is all about innovation and making the best product. Tim Cook's all about trying to make the best value for the stockholder by charging higher prices and hoarding cash and doing some things that are maybe more Harvard Business School-ish, but not innovative like Steve Jobs was when he built Apple. So, the best times of Apple, I think, are behind us for sure. I think the manipulation of stock prices and profits and things can only go so far. And there's some things that kind of bother me about the way Apple runs, where I wouldn't want to have half of my nest egg in Apple. And when do you benefit from any investment until you take profits? I mean, if you die with it, it never did anybody any good. So, I mean, I think you could honor your mom by cashing in the profits. You never get hurt taking profit, not all of it, but maybe over a period of time, using that to enhance your lifestyle or retirement plan. So I don't think I just can't imagine her being that upset. She probably didn't sell it just because maybe I'm sure she had to sell some of it if it was an inherited IRA. And if she was at the age where she'd already started RMD, she was already taking some out. But if that's not the case, then you got that 10-year window to pull it out eventually. Do you want to wait till 9 years and 11 months and then pull it all out when it's worth twice what it is right now and pay double the taxes? Or would it be smarter maybe to pay tax? If it's $600,000, what if you paid tax on $60,000 a year of that for the next 10 years, and it kept you in the 12 or 22 bracket instead of going into the 30 or 40 bracket by pulling all $600,000 out or a million or more out in 10 years. I think you should refinance that into a more tax advantaged account, period. Most financial advisors are just looking at, oh, gee, if I manage that account, how much fees can I get? Oh, you want to leave us in there as long as I can because my fees will go up. And, we do better when you do better. Well, that doesn't necessarily mean you'll do better if you're just going to give it all 40% of it back when you finally cash it in. That doesn't make any sense. It'll be smarter for you to roll out some of it into a managed account outside that's already been taxed that you might be able to buy some more tax efficient products with. Maybe even an annuity for retirement, maybe even a LIRP, life insurance type plan where it's tax-free. You can borrow that money till you die and actually live on more money than Apple might possibly generate for you. I don't think you need to sell all the Apple if you have a sentimental attachment to it, but I don't know what other nest egg you have other than the inheritance, but if that's half your nest egg, I would caution you to hang in there. Enron was a great company until it wasn't. And that's a bad story that ended really badly for a lot of people. And I met more than a handful of people just in my early years in this business that had everything in Enron because their deceased husband or somebody had worked there and had a bunch of stock and told the widow never to sell it. And so she didn't. And then all of a sudden it's gone and she's having to move back in with her kids and leave her little estate down in Yuma to move back to California and occupy a house in the back of their house. So again, it depends on your overall situation. I don't like all your eggs in any basket. I hate 10 or 20% being in the same type of thing, probably at kind of a max level, unless the product is a diversified product. I mean, there are some funds and things like that that might be one account, but they have hundreds of things in them that are very diversified. And that's what makes them monitoring and kind of play the risk game a little bit better for you. So again, I'd have to look at your whole situation, but I think those would be the answers that I would be seeking in that conversation.
Lisa, we appreciate you listening to us in Tucson. And again, our phone number, 520-782-9059, if you'd like to discuss this further with Jeff. And we appreciate you listening to us each and every week. Rick's in Green Valley. Rick says, I'm retiring next year at 63. I'll have $1.5 million in savings. I'm receiving conflicting advice. One financial advisor says I should keep my investment allocated 70-30 in equity/bonds and cash. Another advisor says my investment ratio should be 55-45. My spouse and I have a combined $5,500 in monthly Social Security payments, $2,900 a month in a pension. We also have a monthly rental bringing in about $800 and a small mortgage payment. What advice would you give Rick on that investment allocation?
Pick the advisor that matches your values. I mean, if you want a lot at risk because you can live comfortably on $9,000 a month, then why are you even 30% in bonds and cash? You could go all in if you really wanted to, especially if you're just saving it for a 20-year, 30-year legacy plan. If, however, you want to live on some of that money and maybe make your spendable income like $150,000 a year, might be smarter to put half of that into something that guarantees income and then go a 50-50 plan or a 70-30 plan with the rest. So that would actually be more like a 35-15 plan and 50% in a guaranteed asset. Maybe, now you said all your savings, I don't know if that is retirement savings that's been taxed already. I'm assuming a lot of that is probably 401k money or IRA money that will cause you a tax fit later. But being that you're 63 and that you're retiring next year, there's no reason you shouldn't spend some of that if you want to enhance your lifestyle in your go-go years, which is in your 60s and 70s when you can still run and play and travel and do all those fun things that cost a lot of money. And then maybe a long-term bucket that you invest a little bit more aggressively. I would say that either the advisors didn't ask you the questions to get to know you well enough or the same way. They probably asked you different questions and came up with different allocations. Now, and I will tell you that I lean towards asset protection in retirement, even for people that can't afford to lose money. And so I might be a little bit more on that conservative side, like your second advisor that you talk to. However, I'm also open and I also listen to the client. And if you have an appetite for more risk, then we'll go more risk. But if you just say, hey, what are most of your clients in? I want to do that. Well, he'll probably tell you what most of his clients are in or the type of clients that that person attracts. If you want to be aggressive and be on a gut-wrenching roller coaster ride in retirement with all your savings, do the 70-30 plan. If you want to have a little bit more stability, do a 55-45. But I would say bonds, until they start getting a better track record for holding value and paying a decent rate of interest, I would be scared out of bonds. I wouldn't even do bonds. The bond allocation that I would use would be secured by an insurance company where they take all the risk on the bonds, but they pay me an interest rate based on the indexes they can invest my interest in. And that would probably beat the bond interest and have principal protection that you're not getting in this type of scenario. So it appears that you've gone to financial advisors that only do stocks and bonds, that only do money management, that work for probably the name brand firms that like your money in assets that continue to be able to turn over and generate fees. So if you want a plan that generates a little bit more confidence, income, and things like that, you might want to venture into principal protected and tax advantaged products that are offered by insurance companies. Insurance companies manage a ton of retirement and pension money. There's a reason for that, is because of the safety factors and some of the things that they offer that stocks and bonds just don't do. So, if you want to get into that, or even look at private equity and real estate type investments and things like that, that you're not going to find at the Merrill Lynches and the Vanguards and the Fidelities of the world. You're just not going to find them there. That's why I started this firm, because I could be a boutique firm and actually speak to the needs of my client rather than needs of whatever my boss in Wall Street tells me I have to sell you. So again, maybe the first firm you went has a hard, fast rule that 70/30's their cookie cutter portfolio and everybody gets it and they can dance around and justify it somehow. And if you buy it and like the guy, maybe you'll become their client. And their business model continues to thrive because you've just basically bought into it. The other client might be a 55-45 because maybe they've got some traders in their company on Wall Street that are really good bond guys, like Gunlack or some of these guys at Gross, PIMCO guys. And maybe they've got a really good flavor or handle on bonds and they feel like they can make it safer and still make money in the bond market where maybe the first guys can't. There's a whole bunch of reasons why people would say different things, but I bet you if you go to 20 different advisors, they're going to give you 20 different answers. And I will guarantee you, if you come here, I'll give you a third different answer because I have a different style. I have a different history. I have 35, 40 years in this business that I've seen ups and downs and I've seen market crashes and corrections. Many advisors, there's so much turnover in this industry. You have about a 90% chance of getting an advisor that hasn't even been in this business 5 years, maybe 10 years, just based on the turnover and the ratios. So most people can't make it in this business, even if they work for a firm. So you're probably dealing with somebody that's passing on the directions from up top. And the way I built this business in my 30s, more than 30 years ago, was to build it based on the client's goals and let them be the foundation and dictate our foundation for the plan and build on top of that. So totally different styles. And you know what? All three of us might call ourselves fiduciaries, and we operate to the best of our abilities within that realm of trying to do the best thing we can for our client, putting them first based on what we have to offer. And unfortunately, some people that call themselves fiduciaries, some companies that call them fiduciaries only have one product to offer. And I have a hard time believing that that really puts them in a place to be a good fiduciary if they don't use all the tools in their bag and all the products and services that are available. It's like building your house with just 2x4s and a hammer. I mean, there's a lot of other stuff that needs to go into a good house, like a lot of finish work. There's a lot of finish work that needs to go into your retirement plan as well. It can't just be made out of one product and one tool. So again, consider that. If you're going to build a nice financial house for the future, for your retirement, you want to see a complete plan, we build the whole house over here at Premier, and I'm sure you'd see a whole new world if you ventured in to visit with us.
Rick, we appreciate you listening to us in Green Valley. And again, you can call Jeff at 520-780-9059. If you're not having these sort of conversations with your current advisor, I think that Jeff can help you and give you a second, a third opinion. And again, Rick, it's 520-780-9059. Jeff, our next question is Hayden, hearing us in Marana. Hayden's one of our younger listeners, and he says, I'm getting ready to buy my first home and expect to spend about $400,000. I have the $80,000 for the down payment to avoid the private mortgage insurance. I'm wondering if I should just put down 5%, $20,000, and accept the PMI of about $200 a month added to the payment and invest the other $60,000. What's your opinion?
Definitely invest the other $60,000. $200 a month is nothing compared to what that $60,000 should make you, even in the most safe investment accounts. You can make less than 4% and keep up with that. And you have the liquidity if you should need it for a rainy day or a car or a trip, or heaven forbid you have something bad happen and you need it. But if you plan to leave it as an investment, that's great. And you can get that PMI removed as soon as the equity grows, or you refinance in a couple of years when interest rates go down. So I would just say get the PMI, invest the difference, and plan to refinance as soon as you have the 20% equity that you need. But I don't think $200 a month is worth losing $60,000 in liquid money that you could use for emergencies and other things. Now, I also don't know the rest of your scenario. Maybe you have a ton of money in safe stuff and you're not really willing to take some risks and you just would gonna let it otherwise sit in cash. But you did say you wanted to invest the other $60K, and I think that's a good idea.
All right, Hayden, we appreciate you listening to us. And again, talk to Jeff at 520-780-9059. Jeff, to Hayden's question, you talked about interest rates coming down. Certainly, we did have a rate cut here recently, which should affect the housing market. What are we looking for next year or in the near future that would help Hayden out here in terms of refinancing at a lower than, well, I think the interest rates today be about 6.7%.
Yeah, it's 6 to 7%. Let's just say it's pretty good range, pretty healthy interest rate. Here's the thing: they can keep lowering short-term interest rates, and the mortgage rates could stay at 7 for another couple of years. What it'll take to get the interest rates down on mortgages is going to take a recession. It's going to take a lot of pain. And unfortunately, that's what we go through every so often. It's called a recession. They have them regularly. It will happen in your lifetime a few times. And that's just the way it is. Everybody thinks that the president's in charge of the economy, and the economy's in charge of everything, and it's going to do what it does. It can be manipulated so long. There's tools and stuff that, the Fed's learned to use, and that starting with President Obama started getting approved to create liquidity and kind of create a fake market where it's not based on discovery of what a person's willing to pay and a person's willing to sell for. It's based on whatever the government agency decides futures are worth, or what a bank will be willing to pay for stock and other stock, and what the market makers can do. And if they can print money and give it to them to buy more stock, they can drive prices of the stock market up and create this fake economy and fake wealth that they've been doing for the last 20 years, roughly, and put us in a situation where we have no way to combat or fix it than to raise interest rates, which they started doing back in 2022, 2023. And they're still up. Unfortunately, they're not coming down. And unless America gets so much cash that they can start forcing the price of bonds by selling so much of them, selling bonds we don't have, or buying bonds rather, and driving the price up, we can't really fix that problem. There's too much debt outstanding, $30+ trillion outstanding. A very significant part is owned by foreign countries. I would probably say more than half. And big companies, other central banks own dollars. They own the U.S. bond market, and it creates liquidity and cash. It comes back here and we spend it and buy stock. And then all these other countries own the debt. And if they want to sell it and drive the price down because they need to raise money, they basically create the opposite of creating liquidity. They actually take money out of the economy because they sell the bonds. So we have to give them dollars to buy their bonds back, and the price goes down, which effectively makes interest rates go up, especially on the long term. Anything over 5 years, like the 10-year Treasury, 20-year Treasury, those interest rates have not been falling over the last year or two like they should, especially in light of the interest rate decreases that Powell's announced. He's not in any great hurry to do anything about it. He thinks the economy is clipping along just fine, and that's really just because it's stock buybacks and companies that are generating income and earnings based on things other than productions and products and sales of products. And so there's a lot of hype about the energy and the AI business and the chips and all the technology that goes around that. But that's all future income that they're expecting, not anything that's actually been done yet. So, if those estimates are good, maybe the AI business can help us not have quite as bad a recession. But, the housing market's been hurting for a long time. Jobs are down. People are struggling more. Savings are depleted. Less people are saving than ever before. More debt than ever before. More people borrowing for everything, and more people defaulting, not just on mortgages, cars, and credit cards, but just about everything, and especially like student loans, things like that. A vast majority of Americans are having a harder time making ends meet and paying the bills. And until there's a recession and a reset, I don't think the interest rates on mortgages are going to go down much. I don't care how many times the Fed gets up on their podium and says we're lowering interest rates tomorrow. It is a bigger problem than that, and is a bond problem, not just the Fed speaking what they dictate the rate on a bond should be, because the market dictates the price of that bond, which in turn dictates the rate. So again, I think it'll probably be a couple years before you'll see rates that are worth refinancing. But if you want to buy the house now, because the prices are down a bit, you have a great opportunity. You've got the down payment you need. You can invest the rest and be careful not to lose the rest. Invest the rest in a safe and sane manner where you have a relatively good opportunity to make more than the PMI, like we were talking about with the interest rates on our last question. I don't think it's anytime soon. I think it'll probably be years, not months.
Hayden, good question. Thanks for listening to us. And again, you can call Jeff at 520-780-9059. Congratulations on the first house. And now you need to get your financial plan in order. So come talk to Jeff about that. You're listening to Premier Retirement with Jeff Hogan. My name is Jeff Shade. We're here for you each and every week for your fiscal fitness and your financial education. Once again, 520-780-9059 is our telephone number. Jeff, let's talk about liquidity issues, events that can trigger liquidity issues. To start off, when we talk about liquidity issues, what exactly do we mean in a personal finance or business context?
Well, liquidity issues, meaning you don't have to sell something at a potential loss or penalty in order to pay for it. In other words, liquid money is that cash and savings you have in your bank. Unfortunately, for a long time, liquid money didn't pay a lot of interest, but it was there for the peace of mind and the security that you needed for those rainy day events that might happen. For some people, it could be a kid that gets in a crunch and you just can't find yourself not helping them out and need some money to help them out. Some people, I think, feel a little overzealous in how they help their kids because they hurt them in retirement. So be careful on that one. A health issue. You're not on Medicare and insurance, not going to pay a big deductible. You have to come up with $10,000 or $20,000 for something, or, dental work that could be very extensive. I had a person just tell me that they're somewhere between 40 and 60,000 on dental last year and they don't have insurance for it. So, those things you need some liquidity for. You don't want to have to cash in an annuity or life insurance policy or get a home mortgage on your house in order to do that if you can help it. Sometimes that might be the only way that you can. But for most people, they have some savings and it's smart to put a little bit aside. And as far as that goes, don't put it in a non-interest bearing account. The nice part about inflation lately is that they've raised interest rates on everything from CDs to high interest savings to money market accounts and even a short-term bond account. We use ETFs that are short-term bonds that pay between 4.5% and 6% at very low to no risk and can be liquidated in a day and you get money in your bank account in 2 days after that. So nobody needs to have a pile of cash sitting in their pocket to pay for rainy day expense on Monday if it happens on Monday. They usually have till the end of the week. And with those liquid investments that you can still keep in your Fidelity or your investment accounts, you can still invest them at a higher rate if you can't get a higher rate at the bank. But it's silly not to get interest on your savings money, especially now that interest rates are higher and that banks and brokerage firms are willing to pay money for your money.
So some of the most common issues that people may have that can trigger liquidity issues would be things like job losses or income disruption. You still have expenses, but the paycheck stops. Also, medical events, like you said, even with insurance, out-of-pocket costs can be huge. Also, market downturns. If your portfolio is down 20%, liquidating for cash locks in losses. Real estate transactions. Homes, these days, they can take months to sell. So equity isn't really cash. And unexpected taxes or debt obligations, things like IRS bills and balloon payments or interest rate hikes, they can create sudden liquidity issues. And for retirees, RMDs can force asset sales at a bad time. So you want to have some money set aside for these liquidity events. And as Jeff said, there are some opportunities out there right now in which you can invest liquid cash and still get a reasonable return. You're listening to Jeff Logan, Premier Retirement Planning and Wealth Management. 520-780-9059 is our telephone number if you'd like to set up that casual conversation with Jeff. Jeff, I mention the phone number all the time for people to come in and see you, and I talk about it being a casual conversation. Can you expand a little bit on what this first consultation is really like?
Well, yeah, if you're out kicking tires looking for a new advisor, you got to come in with some questions on your mind. Maybe the conversation started, but what we do in that first visit is just to get to know what your plans are and let you tell us where you are and see if there's a compatible fit. If we like each other after the first hour, we'll set a second appointment. But the first thing we do is we just explain our process. We deal with retirement income. That's the most important thing. When you don't have a job and have income, you need to create income from someplace. And if Social Security isn't going to pay all your bills, and for most people it won't, is there a pension? Can you make your own pension by diverting some of your $1 million in your 401k into an annuity that guarantees you another 40 or 50,000 a year forever? And so you can invest the rest without having to worry about market downturns and things like that. Are you tax efficient? Do you have Roth IRAs? Have you already paid tax on some of that money, or is it something that you need to do? We'll come up with those ideas. Have you already started that? Where are you? What have you started on? What ideas do you have? How much do you like paying taxes? How much don't you like paying taxes? We'll talk about income. We'll talk about the investments that go along with providing that type of income. We'll talk about your risk profile, how much risk you like, how much risk you don't want, what your main goals are, whether you have a family that you want to leave stuff to, or if you want to spend every last dime. We'll figure out a tax efficient approach. Figure out how you plan to cover the long-term care issues should something like that occur. Maybe you already have a long-term care policy, or maybe you have a lot of savings, or maybe you plan to use the equity in your home to do that through either a reverse mortgage or downsizing or something like that. Tell us where you are, what your thoughts are, where you're starting, and we'll tweak where you are and show you how the happy clients that deal with Premier Retirement Planning are doing it. We have a lot of happy clients over the last 30 or 40 years. Everybody comes from a certain place. We want to find out where that place that you are is. And then as soon as we find out where you are, we can find out where you might want to go as we offer opportunities and suggestions as to how other people have become happier with their situation once they've moved from a good situation that they usually are in. Most people come here are in a good situation. We just want to make it better. And then we'll spend the next few days coming up with a plan. We have a template that we've been working on for over 30 years that really comes down to seeing your life on one page. And it shows your income streams. It shows your investment hypothetical returns, some in which are guaranteed, some of which are estimated. We always shoot low and expect to beat our expectations rather than shoot high and come up disappointed. And that second visit's more like a fire hose. We throw a lot out at you. If we like each other after the first visit, and it looks like we're a fit because our values are compatible, if you think some of the opportunities that we have to offer look good, then we'll put it together in a plan and show you how it looks like. If you like it, then you'll take all the information home, contemplate it, kick it around, write down all your questions, and we'll meet again. And we'll meet as many times as you need to get comfortable and understand the plan that is yours. We don't believe in just saying, hey, we're nice guys, move us some money, we'll tell you what we're going to do later. We're not going to give you our secret sauce until you commit to us. Well, you need to know what the secret sauce is before you commit to us. Why would you commit to anything? And it blows my mind that other firms do that. So we don't. We want to make sure that you're ready. And most of the people we never ask a closing question. The question we get typically after the third visit is, so how do we get started? Or how can I get this plan in place? We like it. How do we move forward? If you don't ask that question, we may eventually ask it, but that's usually what people end up with after about the third visit. So that's our process. If you want to come in and try it out, if you hate it after the first visit, you don't have to go the next two, but if you keep liking it, then keep going until you don't. And most people, once they've gone to that third visit, they're part of our family for the rest of their retirement life.
So, Jeff, if our listeners want to begin that conversation, our phone number 520-780-9059. You can make that call right now. Jeff, out of time for this week. I want to thank you for your time, but most importantly, I want to thank our great listeners for joining us here in the greater Tucson area. For Jeff Ogan, I'm Jeff Shade, wishing you a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.